Quantitative analysis techniques. Unveiling algorithmic trading and data analysis in Forex. Introduction. Quantitative analysis has revolutionized the Forex trading landscape by introducing data-driven strategies, algorithmic trading, and advanced data analysis techniques. For advanced traders, understanding quantitative analysis opens doors to systematic and efficient trading approaches. For advanced traders, understanding quantitative analysis opens doors to systematic and efficient trading approaches. In this segment, we will explore the intricacies of quantitative analysis techniques, including algorithmic trading, backtesting strategies, and leveraging data analysis tools to gain a competitive edge in the Forex market. Embracing algorithmic trading. Algorithmic trading, often referred to as algo trading, involves using predefined rules and algorithms to execute trades automatically. Key points to consider include: benefits of algo trading. Algo trading eliminates emotional biases, enhances execution speed, and allows traders to capitalize on market inefficiencies. Algorithm development. Traders can code their algorithms using languages like Python or use specialized algorithmic platforms. Risk management. Implement robust risk management rules within algorithms to prevent unexpected losses. Backtesting and strategy optimization. Backtesting involves testing trading strategies on historical data to evaluate their performance. Optimization aims to fine-tune strategies for maximum profitability. Importance of backtesting. Backtesting provides insight into strategy viability, potential drawdowns, and profit potential under various market conditions. Parameters and overfitting. Beware of overfitting, where strategies perform well on historical data but fail in real trading due to excessive parameter adjustments. Forward testing. After backtesting, forward test strategies on a demo account to verify their performance in live market conditions. Data analysis tools in Forex. Leveraging data analysis tools can enhance decision-making and strategy development. Economic indicators analysis. Analyze macroeconomic indicators' impact on Forex markets using statistical tools and techniques. Sentiment analysis. Utilize sentiment analysis tools to gauge market sentiment through social media data, news sentiment, and more. Machine learning and AI. Apply machine learning algorithms to identify patterns, optimize strategies, and predict market movements. Building data-driven trading strategies. Quantitative analysis encourages the development of data-driven trading strategies. Statistical arbitrage. Identify mispriced assets by comparing statistical relationships between pairs of instruments. Pattern recognition. Use machine learning to recognize complex patterns, enhancing entry and exit points. Market microstructure analysis. Analyze order flow data and market depth to gain insights into market dynamics. Managing risks and limitations. While quantitative analysis offers immense potential, it also comes with risks and limitations. Data quality. Ensure accurate and clean data for reliable analysis and strategy development. Market assumptions. Quantitative models are built on historical data and market assumptions, which may not hold true in all market conditions. Black swan events. Quantitative models might fail to predict extreme events, emphasizing the need for risk management. Continuous learning and adaptation. Quantitative analysis techniques continually evolve. Stay updated on the latest trends, tools, and techniques to remain competitive. Conclusion. Quantitative analysis techniques have reshaped the Forex trading landscape, enabling advanced traders to harness the power of algorithmic trading, data analysis, and systematic strategies. By embracing algo trading, rigorously backtesting strategies, and utilizing data analysis tools, traders can make more informed decisions, optimize trading strategies, and potentially gain a competitive edge in the fast-paced Forex market. However, remember that no strategy is foolproof, and thorough risk management remains vital to ensure consistent success while navigating the complexities of quantitative analysis in Forex trading.